in this session, we are actually going to look at limiting factor decisions. Limiting factor decisions, or the utilization of scarce resources in decision making. Now, organizations usually have to manage their scarce resources, right? They have to manage their scarce resources. So, in light of scarcity, that is unlimited ones together with your limited means or resources. That is the problem of scarcity. Okay, so when it comes to management accounting, most of the time, we know when you are working, you may have limited production capacity. It may be shortage of materials, shortage of labor hours, shortage of machine hours. Any of these may be what? Possible. Is that okay? So organizations are in most circumstances constrained by several factors such as limited production capacity, limited labor force, limited raw material supplies, and limited demand. All these things may be in shortage. Now, when faced with constraints of this nature, management has to make decisions on the production plan that best utilizes the existing resources to derive an ultimate profit, okay? Or to derive your maximum profit. Now, in this situation, management must what? Weigh several production alternatives and give priority to production lines that will contribute most per the given limiting factor. So the limiting factor is either the limiting production capacity, the labor force, are you getting it? The scarce resource. Now, when there's only one scarce resource, a key factor analysis can be used to solve the problem. And this is what we call limiting factor analysis or key factor analysis. Now, options must be ranked using the contribution and per unit of the scarce resource. Okay, so the simple principle about doing this kind of technique in management accounting is to actually look at the contribution that you earn given one particular unit of the scarce resource. So the whole principle about limiting factor decisions is simple. It's like, let me introduce you to it, right? Let's say if you have machine hours, not so. Let's say you have machine hours that are available of let's say 4,000 hours. Let's say 4,000 machine hours. Are we okay? So the whole principle about limiting factors is, let's say, if during the period you have 4,000 machine hours available to use, and you require, and let's say you require 5,000 hours for production, that means you have a shortage of how much? You actually have a shortage of 1,000 hours. So if you have a shortage of 1,000 hours, and then you have, let's say, a product. Let me just give you a product A and product B, which have contribution, okay, contribution per unit, okay, contribution per unit of, let's say, 10 cedis, and this guy being 20 cedis, okay, and then the hours, machine hours required to produce for every unit is actually, we need 5 hours for this guy, and we need maybe 4 hours for this guy. Now, you realize that we are saying here that for 5 hours of machine hours generates that contribution of 10 cedis. And for 4 hours of what? Machine hours in product B generates us a contribution of what? 20 cedis. But then this wouldn't make sense because this 5 hours is for, this 10 cedis is for 5 hours. So you can't really tell which product is doing well until you see how much contribution is earned for each 1 hour of the scarce resource, which is what? The machine hour. Does it make sense? So for every 1 hour of machine, are you getting it? Or for every 1 hour of machine utilization, or for every machine hour that is used, how much contribution will actually be generated? that is what we want to do, to rank to see which one we should produce. So in that instance, since we know that each product actually makes a contribution for this hours use. That means if you put in 5 hours, you can make contribution of 10 cedis for product A. And if you put in 4 hours, you can make product contribution of 20 cedis. So therefore, I must find the contribution of per unit of the scarce resource, which is contribution per machine hour. So in this case, machine hour was the limiting factor, or what we call the bottleneck resource. It slows down the production process because it is limited. You get the idea? So the contribution per machine hour, if we take product A, we are saying that, okay, so for each 10 cedis, not so, we use 5 hours. Not so, so we want to see the cost per hour. How much cost do we make per machine hour? That means for every machine hour, we are actually going to make 2 cedis contribution per machine hour. Not so? And then when we get to product B, that means we make 20 cedis for 4 hours. So if we divide by the 4 hours, that means that for each machine hour, we're actually going to make 5 cedis. Also for each machine hour that is used. If you actually look at it, you realize that product B is the one that is contributing so much in terms of profit despite the limiting machine hour, because this guy uses what? Even with 1 machine hour, you still make 5 cedis contribution, and this guy, you still make 2 cedi contribution. So in terms of ranking, if we want to rank, then we know that product A will be first in ranking, and product B will be second in ranking. So this is what we are now going to use to prepare our profit maximizing output, or a production plan. So the whole principle is this: you want to what? Maximize your profitability despite the scarce resources. Is that okay? So that is what we normally do. So we have some steps that we usually follow when you are dealing with limiting factor decisions. I hope it's very clear. So we first have to what? Determine the limiting factor, which in this case, we saw that it was machine hour, because we required 5,000 hours for production, but then we only had 4,000 machine hours available, meaning there was a shortage of 1,000 hours. Once you're able to determine what the scarce machine hours, the next thing is to what? Calculate the contribution end per unit, which is your selling price minus your variable cost per unit. But notice, or I want you to also note something. When we are going to look at another technique, which we call throughput accounting. Okay, so when we come to throughput for decision making, we are just going to follow the same steps, but when it comes to throughput, your contribution is going to be your selling price minus material cost. Because under throughput, we consider labor and other variable costs as conversion costs, because we incur all those costs to convert materials to finished or semi-finished goods. Okay, so when it comes to throughput accounting, the same steps will be followed. However, material cost becomes the only variable cost, and mostly because throughput is in a just-in-time environment, we don't keep any opening and closing stock. So bear in mind this position. So if you are doing limiting factor decision, its contribution will be selling price minus variable cost. But under throughput, a selling price minus material cost based in what? A just-in-time environment. Now, after you're able to calculate your contribution per unit, the next step is actually to what? Calculate the contribution for each unit of the scarce resource, just like we saw here. We know that this 5 hours was for 10 cedis contribution, and this 4 hours was for 20 cedis contribution. So how much for just 1 machine hour? How much contribution do we make for each machine hour? So for each machine hour, we divide by the scarce resource available. So you realize that you get what? The contribution per scarce resource, or the contribution per the limiting factor. Then after that, you rank in order of what? Priority, the one with the highest contribution per limiting factor. Then from there, we prepare an optimum production plan. Then we get our maximum possible profit. So I told you that the same steps will be applied in a throughput accounting analysis. But note, the only variable cost in throughput accounting is material cost, because all other costs are treated as conversion costs or factory costs, operating expenses, because they are incurred to what? they are incurred to convert raw materials to finished or semi-finished goods, actually in a just-in-time environment. A just-in-time is we have materials just in time for production, or we have inventory just in time to distribute to our customers to meet the exact demand. So we may have just-in-time production or just-in-time purchasing, right? You purchase to sell or you purchase to produce. Is that okay? So this is the concept of limiting factor decisions. Okay, now it comes to the concept of what? Shadow price. We are going to look at shadow price in a more later lesson. So when we talk about shadow prices, according to Lynch in 2003, he noted that a shadow price is the loss or gain in contribution which would occur if the availability of a scarce resource were to change by 1 unit of that resource. It is actually the maximum price to be paid for an additional unit of scarce resources. Now, this price is useful because of non-existence of intermediate market price for those resources. So what happens if we incur or we add an additional 1 hour to the available 4,000 hours we have already, right? The extra contribution that will be generated as a result of this extra hour we add to this 4,000 hours available becomes what we call the shadow price. Is that understood? So when we go more into a detailed discussion in a question, we will see how we can utilize the shadow price. So most of the time, a full question can come for 15 marks with shadow price of 5 marks, or it can come for 10 marks with a calculation of shadow price for 5 marks. Whatever it may be, you should be ready to deal with limiting factor. It mostly appears often in the exam, whether it comes as limiting factor or throughput, or it can also come as CVP. So you should be ready to deal with these problems. So in the next scenario, or in the next session, we are going to take some questions on limiting factor, and then I'll take you through throughput accounting analysis.